Okay, I think we got the most widely anticipated rebound ever today. I think everybody was kind of looking for a bounce back up, and we got it actually early Friday or late Friday into today and throughout today. And it's a good sign that most of today's gains came during the day. So I think that helps. It doesn't necessarily change the trend, but it helps set the low with what we saw at the end of last week. Now the question is, V bottom or not? Right, that's what everybody's talking about today. So I'm going to talk about that and what we should expect to see going forward from here, and how much longer this rebound might go, where some resistance levels might be. Then we're going to take a look at a trade on the stock that's also bounced up like the markets. We're going to talk about how to trade this bounce, knowing that there's still some volatility left in the markets to bleed out, as well as potential moves to the downside. With obviously the potential of the V bottom to continue to go to the upside. So how do we trade that? So that's what we're going to do with our trade idea of the day. So let's go ahead and get started. Today is Monday, March the 2nd, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the market forecast indicator. And you can see what a great day this was. But you also notice that it didn't clear yet into this Thursday's gap that we had at the open. So it's a good day. This kind of shows how bad Thursday and most of Friday was until we rallied at the end to close at the high, and then rallied and closed at the close there. So but you can see the short, and also you can see just how bad it was, that like this big rally we've had. And we're off of the lows here, 28.55. So we're off the lows by 135 points. And still, the momentum and near-term lines are just not even in the upper reversal zone. And if we were to go back again, to compare these other times where we dropped really, really sharply, the near-term line did, in this case right here, this was just an intermediate pullback too. But if you look at this instance here, the near-term line rallied back into the upper reversal zone. So it looked really bullish, even though we didn't get close to the moving average. And then over here on this period, the near-term line also bounced into the upper reversal zone. When we first had that big drop, again, didn't get close to the moving average there either. And then finally going back over here, we had the big drop. The near-term rally also got well into the upper reversal zone and still didn't get up above the moving average. So keep that in mind, that I actually wouldn't be surprised if the near-term line didn't get. So that means maybe another day or two, or maybe small pullbacks. But I wouldn't be surprised if that near-term line did get in the upper reversal zone here. That would not necessarily be bullish. We are still way far away from getting a green line, which would be trading above a rising moving average, which is bullish. So it's a nice day. It's a nice day to recover some losses if you're still in some long trades. It's a nice day to get out of some long trades at better prices than you would have, on Friday. It's a nice day to start looking for some trades. You'll see with our trade idea today, the type of trades that we look at, that we'll look at there. It's a nice day for those. It's a nice day to maybe enter some bearish trades as we get closer to rolling over. So it's a nice rally, but it's not a trend-changing rally. We're not back. We have dark pink shading and yellow and a red line. So we're in bearish mode right now, and we are just barely recovering. The Russell 2000, which has been the worst one, it closed above Friday's high point. You can see its short-term sentiment is still in the lower half of the chart, and its market sentiment line is falling as well. The NASDAQ composite did fill in Thursday's gap, so it looks really good, but you can still see its intermediate posture is still in the lower reversal zone there. And the Dow Jones Industrial Average looks very similar. So nice bounce there, but not trend changing. Not trend changing in the least bit. And so the expectation is that it still could very well take, I'm expecting it to take a couple of months, a month or two, because I actually still expect that we'll get a death cross here, where the 50-day moving average will fall below the 200. You'll see that here in just a second. But I still expect that to happen with this pullback because of how far we came below the 200-day moving average. And so with that being the case, there's a good chance that it might take, there might be a month of ups and downs. And don't get too caught up in the overbought near-term lines and thinking that's really bullish, and now we got a trend change. It's not a trend change until you get dark green shading and a green line. As long as we're below the moving average, it doesn't matter what you're doing up and down, you still got a red line, right? And we've got a long ways to go before we don't get a red line here on the market forecast indicator. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also a subscribe button down below our video. That will notify you when these videos are posted. Hit the thumbs up icon down below the video. That tells us two things. Number one, you liked our video today. And number two, you want us to do it again tomorrow. So quick way to give us feedback. If you don't like our videos, you don't have to click anything down there. Also, while you're down there, comment, what did you get out of our videos today? We always love to hear what you got out of it, why you found it useful. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe. To subscribe for free to our site. Follow me on Twitter for more content in between these videos from day to day, and join our join our Market Outlook Facebook group that we've created. Also, if you're watching us here through our website on our blog, you notice we have all of our classes, Market Outlook live video, links to our subscription plans over here under pricing. If you click on the word pricing, it will show you the differences between the two and what you get. You also see we have our today's Market Outlook tweet and Facebook post. We ask that you click right here, click on that heart. It opens up this window. You can like today's Market Outlook tweet there. Click this thumbs up. It opens up your Facebook page. We invite you to like our Facebook posts. Again, the more you click on those, you engage with us on social media, the more likely those platforms will promote all of our content to the top of your timeline. So that way, when you're not watching it every day or throughout the day, when you come back, they'll push you our stuff that we've put out there in the meantime. They only do that with the accounts that you engage with the most, so we try to make it really easy for you to do that down here. All right, back to our charts. Let's take a look at the long-term chart. I told you about the possibility of a golden or death cross. Excuse me. That possibility persists as long as we don't finish too sharply above the 200-day moving average, right? If we were to come down, close below it, then get right back up above it, then there's obviously not going to be a death cross. But the more you get below it and then you stay below it, and here you can see we kind of went above it a little bit in a couple of weeks, but as we stayed below the 200-day and the falling 50-day moving average, then it turned into a death cross that eventually we came out of, right, with that little last couple weeks fall. So again, you can see where the 200-day moving average is. You can also see too, I mentioned that 312 area. I'll bring that up again here, but you know this is where that 200-day or the 200-day moving average is in SPX, about 308, kind of where we're at right now. And then you can see the 62% right now is where the 50-day. You can see that can act as a resistance on the way down once you get below, right? Just to have it act as a resistance on the way down here. So that's kind of the best case scenario for any kind of bounce we get here, whereas probably this is the worst case scenario, that this is all the bounce that we got, considering we're at the 200-day moving average. And then where we finish this week will be really important, right? Because again, the more likely, and again, having a death cross will not mean we're heading to recession, because we didn't have one over here, and we haven't had one since forever, right? Since 2007, 2008. So a death cross doesn't mean recession, but death cross just means that it takes a while. It takes a while to get going back to the upside. You know, after we fell in October, you know, it took a while. We hit that bottom on Christmas Eve, but to recover all of these losses took about another couple of months before we really started to break out and move to the upside. So it's gonna, you know, it's gonna take a couple of months, but that's kind of what I expect. And again, you're more likely to get that death cross if we finish the week below the moving average, especially below the 200-day moving average. This is the Hakinyashi candle, and you can see the low point of this candle. When you get these lows, you still tend to kind of retest these lows. As big lows as we got, you tend to retest these, and in this case, we went down a little bit below it. So I still fully expect that we'll retest these lows like we've seen in the past. If not, you know, in the next couple of weeks, then you can see here like about a month later. Because like I said, a month to 2 months is how long this can take to finally wash out and then turn things back around with small. See how the ranges got a lot smaller, and then we bounce back up. And it's very likely something like that will occur again. Let's take a look at the 3 green arrow charts, and this is kind of the interesting thing to me. Of course, we still got 3 red arrows, even though the stochastics is bouncing up, and you still had a lot of volume today. But this big bounce that we had, it still didn't get us above not only the 200-day moving average, but the 8-day exponential moving average. That's how far below the 8-day we were, and why it was very likely, even on Thursday, to eventually bounce. But you know, that's significant. Interestingly, the MACD turned up, the histogram turned up, and it will. Like, you know, when you look at some other charts here, you go further out in time, you can see that when you get, well, in fact, we got to go a little bit further. When you get these big drops in the MACD, and let me zoom in on the MACD, we can turn up, and like I said, you get right up to that 17-day moving average, and then we hit that for resistance and roll over to the downside, or the 8-day moving average. That was on that drop. This was the intermediate drop earlier in August, and you can see it bounced back up. Going out here to December, when you got that big MACD and we pulled up, we got up to the 8-day moving average and hit it for resistance and rolled down. And go back to January, we came down, hit that 8-day moving average for resistance. You know, as the MACD rolled over, then we kind of rolled up and stalled in that area. So that MACD is rolling, and when that MACD rolls up, it will turn green. Like the MACD will go from these really sharp bearish moves to green pretty quickly too. So we can bounce up pretty quickly, but keep in mind how far we can go up and still meet some pretty strong levels of resistance on the way up, and roll back over again to the upside. And even on that case, it's, you know, on intraday moves, you can still have plenty of ups and downs on the way up. And even today's volume at 238 million, if I remember correctly, and 15 points of range, I mean, that's still bearish. Even as bullish as we were today, those are bullish. Those are bearish ranges. That's bigger than any of the ranges we had last week when we were in the 12-point range. All right, if you look at the intraday moves, you can see where, you know, the 60, you know, you can see there's a big volume node up here that is also going to be a Fibonacci retracement area. You can see the 50% node, that 312 area is kind of what I've talked about before as an important level to watch. You can see there's still not very much, and even if you look at the futures contracts here, and up just a little bit here so far tonight, but you can see there's not very much volume, a little bit there, a little bit more up here about this 32, 44 level. There's not very much volume below us either. So as quickly as we rallied, we can fall just as quickly. We've gone up and down so quickly without very much volume that, you know, don't think that that's a lot of support below where we're at right now, because it's not. But it also, you know, means that we can go up and down a lot and fill in a lot of volume in this area and and you can see that big value area sitting right on top of where we're at, that 50% level. You know, that's a big chunk of volume right there. Bring that down below here as we fill that in, then it will act as more of a support level that will be a lot harder to break through, and will really establish this level as a low point, or again over the next month, 6 weeks, 8 weeks or so, before we really get going, establish that low that we can bounce off of. And again, you know, the more and more I look at how things are going on yields and things like that, when we do get going again on the new long-term market sentiment run, we have the potential to make a really good run out of it to the upside. So it's going to be kind of like back up the truck type move that potentially we could have. Of course, anything can happen, but that's the type, from a technical standpoint, that's the type of move that's anticipated to come out of this next couple of months basing pattern that we could be developing right now. Let's take a look. I mentioned the volume at 238 million and the trading range today at 14. Again, that puts us up to above 2%. We're getting easily above 2%. This is lagging too, so it's going to keep going up here. So, you know, again, another sign we're probably going to get a death cross, more than likely. But again, the higher up it goes, the longer it takes. It's going to come back down to these levels, right? Down to 1%, as you can see here on the daily chart. So the higher it goes, when you get these death crosses, and these were death crosses that got above 2%, then you can see how long it takes to get going. So we really can get going to the upside with moves off of these really high levels. You can see over here in August of 11, we got all the way up to 3%, and look how long it took to come back down below 1%. A little bit of a jump there in 2012, and then right back below 1%. So, that's kind of the idea. Is it's going to come back down to 1% again as it rallies higher. So the higher it goes, almost the better it is, right? 6 points. Wasn't 6 points over here because we were down at 115 instead of 300, but still from a percentage standpoint, 3% is probably about where we're going to be headed to by the time all is said and done on this. Because 14 points today is well more than 3% of the price right now at 309. That's more than 4%. So there's a good chance that, and we have had, if you take a look at the last so many days, we've had 1, 2, 12-point range there, 14-point range there, 7.5 there, almost 13 there, 12 there. So that's 1, 2, 3, 4, 5, 6 out of 14 days. That means we still have 8 days where we didn't have very much of a move at all. So over the next 8 days, that ATR percentage is really going to ramp up there. Last thing we'll take a look at here before we take a quick pause is this volatility chart. And again, not surprising, we talked about this on Friday, that the good chance we'll get these long upper shadows and on the chart, and when we get them on the weekly chart, we tend to fall back down, and we might fall back down for another week or two. So that's fully the expectation here. You see it starting to come back down. It's not below 30 yet, but definitely could come back down below 20 and hold it for a support and come back towards 1, as you can see on the daily chart too, that when you get these spikes like we've had that lead to these type of death cross moves, but when you get these spikes, it will come down pretty quickly and hit that 1, the 95% 1 level immediately for support. Same thing over here. It came all the way down and hit that 95% level immediately for support. So a very similar thing can happen here. And for us to get down to 95%, it's probably going to be a move down to 25.20 in that area. So nice drop in volatility there, which is really, really good for those that sell volatility at these really high levels. All right, before we look at some other charts, talk about what's driving this action today, we'll just summarize our technical outlook with the idea that it was a nice, good bounce today from extremely oversold levels, but not a trend changing. We're still very strongly in a bearish posture with a looming market sentiment pullback, with already the intermediate pullback and the high potential for death cross, which just basically means we've got some time to work this bearishness out, this volatility out. It's not going to happen overnight or in the next few weeks. It's probably going to take a while. So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing differently? And then share that. Share what you're seeing differently. Everybody's got their opinions, right? I think the market's going to, the Fed's this and Fed's that. But what charts or what indicators are you looking at that would tell you either you're a lot more bullish on this bounce, or or this is just a one-day reprieve and we are going to fall through the floor? So share that down below. All right, well, let's take a look at what's driving this price action. Interesting to see the rally we had. So we had this obviously deep decline in risk asset classes, including real estate for that matter, during this pullback, right? This 1, 2, 3, 4, 5, 6, 7 day pullback. And then today we bounce, and you can see how much of this drop that we've bounced back up. You can see everything's bounced, including crude oil. What's interesting, though, is if you notice, long-term bonds did not pull back, right? Gold pulled back a little bit. It didn't really rally as much over the last few days, but look at long-term bonds actually stayed up. So not as much of a risk back on move as you think it was. It was more of, and look at that big decline in the 10-year yield down to 1.08% with another cluster there. It's a pretty extreme low that we're getting on the yield, and it continues to show that divergence we've been talking about for weeks now. That divergence developing is setting up a nice, good opportunity for a big bounce to the upside. And with yields as extremely low as they are, setting up a really big move in stocks. When yields make these big moves, stocks make big moves to the upside. Stocks were up like 30% from that low point in equities all the way to the end of the year, to at least to that high point in October 2018. A year and a half, and you're talking about mid 30% range on equities, and that was coming off of that low point. If you were to go back, another period where they went up about 30%, was off of that divergence low point here, where we rallied up there from the middle of 2012 to the end of 13. So these big moves you have on yields from really low levels typically signify big moves in stocks. So a good sign for equities going forward from here. And the same thing, we saw a little bit of a decline in gold. You can see, this Hakinyashi candle. Now we have a bearish candle, at least a transition candle, that we might start transitioning towards a bearish move on gold prices. Let's take a look at the dollar. That's been an important element for what's going on. You can see the big decline it's had. It's now in a bearish pattern, reversed that whole big rally that we had. And we talked about how it's really hard for stocks to be too bullish when the dollar's rising so much, and that led to a big drop in equities, obviously. And during that drop in equities, the dollar's dropped too, and it's setting up eventually for a nice, good move to the upside in equities as the dollar is pulled all the way back down and pretty much lost all those gains, and now has a dark pink shading red line pattern forming on its own chart. If you take a look at that 5-year chart, big chart there, a big bearish candle engulfing a couple of weeks, rolling over on the intermediate line, and potentially setting up for dark pink shading and a red line there. We haven't had that. You're going to see briefly here a couple of times, but we haven't had an extended run to the downside and the dollar for quite a while. You can see a couple of them right over here, and then this big one here where, again, equities did so well. Again, a bearish move to the downside for the dollar would be really bullish for equities as well. So you can see, as volatile as we are, and I don't expect a V bottom. I expect another month or so for this to really play itself out. But it's setting up, here as we build a base and as we build a foundation at a low point. It's setting up for a really strong move in risk appetite because of how overbought these safety trades are, and also, for that matter, because of how still oversold, commodity prices are. You can see how crude oil just really has not been able to get going for the longest time. In fact, if you were to throw on a comparison chart here of the S&P 500 to crude oil, you can see just how bullish, it's been really, really bullish this whole time. That whole rally we had there in crude from $30 all the way up to almost $80 to $75. We've since have pulled back, and while S&P has really rallied up to the upside, well up above these October highs, crude oil is not anywhere close. In fact, the S&P is actually still above those highs while crude oil is down. So it's been really, really lagging, and it is a laggard. Commodity prices do lag behind equities. But it also, again, goes to show, if commodity prices were super expensive and yields were really high, then I'd be worried about recession with this bearish move. But considering that they're so low already as it is, it's kind of hard to go into recession when there's no excesses to play off, right? Stocks have been excessive, but really even mainly just U.S. stocks, as we've seen before. International stocks still haven't even come close to breaking their January 18 highs that U.S. equities are still above, despite the pullback. And international stocks are not even more close. And same thing with emerging markets, not anywhere close to their January 18 highs, while the S&P is still holding up above it. So again, kind of shows that we're not nearly overbought at all in risk. There's still plenty of risk appetite to go on and take off once we get this low point figured out over the next next basically 6 to 8 weeks, as we go up and down, and with this bounce in volatility, spike in volatility that we've had. Not surprising to see the sectors all looking very pink, red lines, dark pink, and look at all these bounces that they all have had to the upside, coming off an oversold clusters. They all, when volatility jumps, the correlations between these sectors really they go pretty much to 100. So big correlation right now. Whoops. If I take a look at just the comparison chart here. And then let's go back since the start of this pullback on the 20th all the way up till now. Okay, you can see since this decline that we've had, there's where the S&P 500, not surprising with energy down, with crude oil down, energy is still down and it's lagging behind. And your safety trades were holding up okay until Thursday and into early Friday. And then now we're bouncing. And you can see during the bounce, the biggest gainer so far has been, at least they're still holding their gains, is all these safety trades are all bouncing to the upside. And if I just take a look at just today alone, here we go, March the 2nd, you can look at utilities and staples were the big winners, along with real estate. So again, not your most risk. I mean, that wasn't even like, a bounce like with all the work. I mean, look at energy and industrials are still down there. So there's still economic growth. Expectations are low. So this was just basically a safety trade bounce, right? It was, hey, we're really worried and things are oversold. So we're going to buy this bounce, but we're going to be really safe with what we buy. So that's not risk on, right? We're not looking, that's not the type of pattern that you would see that would say, okay, here we go, V bottom back to the upside. It's the type of pattern that says, okay, we're bouncing and we're not really sure of this bounce. So we're going to buy what we can. What won't go back down very much. And that is those safety trades there. You can see that technology is one of these areas that bounced up the most, and that's good for a stock like Adobe. If you notice, Adobe has been a really bullish stock. It pulled back just like everything else, a little bit of an engulfing pattern, then it bounced back up to the moving average today. Actually has light green shading again, so not as bearish as some of these others. If you notice, when you look at its Bollinger Bands here, we came down to a Bollinger Band level, but there's still more downside, especially with earnings coming up. There's still more downside potential, and the upside potential is going to be limited by the broad market's overall sentiment as a whole. And we know that there's, while we might go up to these old highs, most likely we won't go up to newer highs. Those aren't nearly as big of a concern. So you also take a look at the long-term crossover chart here. For Adobe, and you can see, we're in the midst of, we got the red line, we're kind of filling in the gap between the 200-day moving average and that kind of slow move to the downside. You look at the 3 green arrow charts for Adobe, and you can see back up above or towards the 30-day, back above the 8 and the 17 with a rising MACD, but still pretty bearish sentiment. So the nice thing about that trade is we can say, okay, let's look at selling an iron condor spread. And we look at if you take a look at the 20 deltas, we'll go 46 days out, selling the 20 deltas. And you can see the 310 now is at a 17 delta. At the time it was around a 20 delta. And this was also around a 20 delta, the 400. Obviously now you can sell the 405. But buy these strikes for protection. This is what it looks like. You have the break-evens here at 54% probability, a return of $495 for a risk of about 1,000. So almost about a 50% return on risk. And those break-evens on the risk profile are on the chart right here. So essentially, as long as that support holds down here where that big value area is, there's a big strong support down there. And if we do go up, if we don't go, if our upside is limited by this potential volatile market that we're in, then as long as we stay anywhere in this area, then we make money on this trade. And that's kind of the nice thing about being in volatile markets. In fact, if you look at the stock, its own volatility moves, you can see, look at that big strong move we had today, over 4% after some really big strong moves to the downside. Look how high its implied volatility already is. As one of the highest levels it's been with this decline that we've had in a long time. You can see when we got this high over here, we had some ups and downs, but we didn't go anywhere. And because of the high implied volatility, we're able to have a pretty wide range. And then we expect that, especially with the historical volatility ramping up pretty quick, we expect that now it probably won't go anywhere as the volatility settles back down in the Bollinger Bands, which has got that relatively high bandwidth, also starts to settle back down again. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link right there popping out in the top right corner of your screen. That takes you to our Market Scholars website, to our forums on our website, or specifically our Market Outlook forum. One of the things you get when you subscribe to our site for free, you get access to. Open up any new thread, and that's, you get access to us there as well. So post any questions or comments you have, reply to anybody else's threads, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video down below. Follow me on Twitter for more content between the videos, and join our website at marketscholars.com, as I showed you before, as well as our Facebook group for Market Outlook viewers. Again, have a great rest of your evening, everybody, and we'll see you all next time.